Did you know that there is no legal definition of an ordinary share? And that means that as a consequence, we can, within reason, create any class of shares as we want, with any kinds of rights and restrictions attached to it as we wish. So in this video, we'll discuss the most popular classes of shares and what other rights and restrictions you might want to consider when creating different classes of shares. If you're new, let me just very quickly introduce myself. I'm Malcolm Zoppi, an English qualified solicitor and the managing director of Gaffney Zoppi, my law firm. And on YouTube, my goal is to make business law easy. Make sure to stay until the end of the video to find out how to actually go about creating different classes of shares, and importantly, how to comply with the laws when doing so. Amazing. Now let's start off with the three most popular classes of shares, starting with the obvious one, the ordinary shares. Typically, ordinary shares have the right to vote and the right to dividends. So the right to dividends, as we all know, is the right to be given a percentage or a proportion of the profits of the company after corporate tax. Who are ordinary shares for? Typically, simply the founders and co-founders in a small company with really no outside investors. Moving on to preference shares. Preference shares tend to be quite hands-off, but have a greater chance of receiving dividends. They're hands-off because typically they don't have the right to vote, but they have a greater chance of receiving dividends because they are the first ones to receive dividends above everyone else. And typically they are guaranteed a fixed amount of dividend per quarter or per year. Preference shares can be great if you're taking on investments from a hands-off angel investor who is not really interested in helping you run the company and vote on decisions, but instead believes in you and simply wants a greater likelihood of getting some kind of return. Separately, I've also seen companies and founders give preference shares to their family members and friends. Now let's talk about redeemable shares. These are amongst the most interesting shares in my opinion. They are temporary shares. Let me explain. Typically, the company has the right to decide to buy back those shares from the shareholder, or on the reverse, the shareholder has the right to request that the company buy their shares back from them. So when would you actually use redeemable shares? If it is the company that can decide when to buy back those shares, then it might be appropriate if, for example, the company wants to give some shares to an executive team of the company, but retain that flexibility that if the executive team member leaves the company, those shares can be bought back. In that case, there will be a clean break between the company and the executive team member. The second option, whereby it is the shareholder that has the right to request that the company buy their shares back, can be suitable as an alternative debt instrument. So for example, you might have an alternative lender who's willing to lend your company money, but your company isn't really rich on assets. Doesn't have a very strong balance sheet, for example, is simply a service company that does professional services and doesn't really need to own many valuable assets. Instead, you can give the lender these redeemable shares, and when the lender wants their money back, they call on the company and ask for that money to be paid back in return for the shares to be given back to the company. Now, before we move on to discussing the other interesting and creative rights and restrictions that are available at your disposal when creating different classes of shares, make sure to subscribe to the channel to continue to receive practical, pragmatic, and to the point legal information. Also, if you're interested in a free legal advice call, make sure to reach out. I have my contact details linked below. Amazing. So what other three main kinds of rights and restrictions do you have at your disposal? Number one is drag-along provisions. Drag-along provisions, put simply, state that if enough holders of shares are willing to sell to a third party, then those holders can enforce or drag along everyone else to also sell their shares to that third party. Drag-along provisions are fantastic if, for example, you are a founder of the company, you're taking on minority shareholders, for example, as investors, but you want to ensure that if the day comes that you are approached by a private equity firm who is willing to buy your entire company, you can drag along everyone else to sell their shares to that PE firm. Secondly, we have tag-along provisions, which are similar but different. Tag-along provisions, put simply, say that if there are enough shareholders who are willing to sell to a third party, the other shareholders can also request to sell their shares to that third party at the same price. And lastly, we have anti-dilution clauses, which are especially relevant if your company is going to be doing a few fundraisers and you have early stage investors who want to avoid their shareholder being diluted. As a bonus, if you are looking to take on investors and shareholders but want to maintain control over your company, do one of these two things. Number one, make sure that your classes of shares of you and your other important and valued co-founders have either more voting rights than everyone else. So for example, for every one share you have 10,000 votes. Or number two, reserve a specific amount of decisions to your classes of shares only. So that means that only your class of shares can vote on those specified decisions. Now, if you're looking to create different classes of shares, make sure to comply with the Companies Act. And if you want to find out how to go about that, make sure to watch this video right here. Thanks for watching.